Understanding the region you're buying in is crucial in detailed due diligence. The region will affect how your property performs in the short and long term in terms of the tenant's success, vacancy rates, and capital growth. The aim is to ensure that you always have a profitable tenant. And today's video is all about vacancy rates. Commercial real estate values and rental income, like all commodities, are a function of supply and demand. When the supply is high with high vacancy rates, there is usually a strong degree of pressure to drive prices down. When the supply of commercial real estate is tight and vacancy rates are low, the price rises to meet the demand. So, unfortunately, one of the biggest risk factors with investing in commercial property compared with residential is the longer vacancy periods.
We have a number of cities recording rental vacancy rates below 1%.
The vacancy rate's roughly doubled from pre-COVID levels and it's struggling.
That's why investigating a property's vacancy rate is definitely something that should be high on your radar when doing area research. The vacancy rate is used as a pointer to establish how the property is performing overall when compared to the average vacancy rate of commercial properties in the same area. To simplify the term and its importance in real estate, I would say that you want to avoid a property that has a high vacancy rate because it might indicate there's an economic downturn in that area. High vacancy rates for a particular property also mean that the property may be undesirable or be in an undesirable location. In terms of a game plan, when checking the vacancy rate of a particular property, I'd suggest that you speak with property managers to figure out the demand for this style of property and do a historical occupancy study. You could also do a little bit of your own research online. For example, you can check out a properties and comparable properties advertising history on CoreLogic. Once you have some information, if it's clear that the risk of vacancy outweighs the long-term net return, don't be tempted by the high net yields. I'd also advise you check what kind of competition there is in the area because there could be other properties where your tenant could potentially move to. Ideally, there shouldn't be too many competing properties in the immediate vicinity and not much land nearby that can be developed into the same type of property. Anyway, folks, I hope this is giving you a little bit of insight as to what to look out for when it comes to doing area research and checking vacancy rates. There's quite a lot more detail that goes into the due diligence process. So if you have any questions or would like to know more, get in touch today. Otherwise, make sure to like and subscribe for more commercial property investing tips and tricks. I'm Steve Palise, author of Commercial Property Investing Explained Simply. Thanks for watching, guys.